Well, bond traders are about to find out how worried the Fed is about inflation. Janet Yellen and her expected successor, Jay Powell, lead a busy lineup of policymakers speaking this week. Let's launch this week's Real Yield with Manulife Asset Management's Eric Liu. What are your thoughts on this?
We do see that Powell is going to come in and give a testimony later this week. And at the same time, if you look back into the minutes or whenever Yellen speaks, they have been very confident that inflation is going to come up, which is very different to where the bond markets are trading now and how the investors are seeing things. We do see that inflation has been upticking, but is it going to last? That's the question. But I think the question to ask is, given that the Fed is now very determined to increase rates and continue to increase rates, I think that trend is going to continue.
Eric, nobody knows, essentially, because it's economics and people act differently. Nobody knows. We've had people sitting there saying that the inflation is going to be not a problem for years, and we've had other people sitting where you are saying people are far too complacent about inflation and inflationary pressures at the moment.
That's definitely true. If you look into where the yield curves are pricing being so flat, that's also a sign of what you have just indicated as well. But I think if you need to look into where the Fed is a dual mandate bank, they have the economic data, which is actually growing very well. Unemployment is actually all-time low. And that's what the Fed is actually worried about. When the data is doing so well, when the growth is sustainable, as the prices are continuing to go up higher, inflation is something that they can put at the side for the moment.
Why is there such a little amount of inflation, and why is there, perhaps in some ways, you could argue with the PCE deflator, I think, out on Friday, that's looking like it's moving down, that we're getting less and less inflationary pressure? Inflation
is a big question.
And do we need to rethink inflation as well? Sorry, I'm shooting this one at you as well, because with the sharing economy and the way the world has changed, it's perhaps not the best indicator for price rises.
That's definitely true. And we do feel that the central banks have been starting to think about, is inflation a good target? Is the target something that needs to meet? And we have seen various central banks, especially from Canada and Australia and even in Europe, starting to talk about it. And I think this is something that the central bankers are also thinking about it as well.
Let's look at China and take a look at the bond market there here. Very, very volatile. Yields been going up across the board. Credit spreads widening, all part of this deleveraging process. Again, nobody can make up their minds where we are with the deleveraging process.
Deleveraging is still going to continue. We actually been calling for yields to go up higher since the end of last year, and yields have been going up by 60 to 70 basis points higher. We do feel that yields are going to still continue to go up higher, especially with the 10-year CGBs potentially going to meet 4.5% in the short to medium term. But the focus here is at valuations now is actually very attractive. And we do feel that given the economy is showing some signs of robust growth, and at the same time inflation is upticking. But when the overcapacity issue is still there, the inflation is very hard to sustain at these levels.
Is there an overcapacity issue still? If we look at industrial profits, they've been rising and rising. If we look at the factory gate numbers, the PMI is coming through there, PMIs and PPI inflation, I should say. That all seems to suggest that excess capacity and inventory overhang has, in many ways, been dealt with because these companies don't have pricing power, which is being shown up in those industrial profit numbers.
It's improved.
I got there in the end.
It's improved, but we're not there yet. And I do feel that China, especially the regulators, are very concerned about, is it too fast to stop this deleveraging process and stop the supply side reform when we're only halfway there? And it's a long process. We're still going to see more to come.
Tell me about the bond space, that because ultimately, if we've seen these yields continue, particularly corporate bonds, and they've got so much debt on their balance sheets, at least some of them, do you expect a few bankruptcies next year, perhaps?
We're going to see more bankruptcies. But that's not what we are worried about, because it's actually going to be a healthy development
in the longer term.
In the longer term for the investors, making the financial market more sophisticated, more robust. And default levels have been artificially low in history for so far. So what we are going to see is that for sure we're going to see more defaults. But for investors, this is actually good news. And even though if defaults are going to go up higher, it doesn't mean that everything is going to default. That's not our base case, and it's not what we're going to say. So the stronger companies are still going to benefit. If you look into the stronger SOEs or even some of the stronger private companies, they're still going to be very robust as well. So default levels are going to be higher, but it's not something that investors should be afraid of. And because now we see that defaults are going to be higher, at the same time, the law and the framework is going to be more robust, it's actually going to be more sustainable and more beneficial for foreign.
Well, there may be more bankruptcies, but they won't get out of hand, I would have thought, because there is still the self-interest of the ruling party and the ruling government.
In terms of what you mean by the government can control...
The Beijing put, as some have put it.
So I would say the government has a very, very strong determination to make financial stability a key agenda in the coming years. And this is something that the government is very clear about. So are they willing to let go of things? We're going to gradually see the government let go of more things. And we've been seeing that happening for the last few months and the last few years as well. But it's going to be a very gradual process and going to be a fairly slow process as well.
Let's just talk about one of the stories that we've been covering today, and it is, we're going to be looking at it in a bit more detail, actually, during the course of the programme, but how we have China snubbing Singapore, or at least it seemed that way, in these Asia dollar bond market sales.
So what has been happening, as the article has been saying, is that a lot of the issuers have been not going to Singapore or not going to the rest part of the world and just holding roadshows in Hong Kong and in China because the size of the Chinese investors are getting larger and larger. And a lot of these smaller companies are trying to say, I don't need a lot of money. I only need 100, 200 million US dollars. And I can satisfy this demand already in Hong Kong. So there is going to be this negligence coming from issuers wanting to save costs and not needing to go to other parts of the world to do marketing. Now, it's true that is not good for the to the investors and also the issuers because they need to diversify their source. At this moment in time, I feel that is still too young and too short of a sample size, and we're going to see probably investors making voice and issuers going to come in and see them as well.
Eric, I was just looking in your research, and one of your contrarian things is that you are at the moment expecting bond yields to edge higher. But do you see that as a buying opportunity?
Yes, definitely.
But the price is going down.
If you look into the whole real yield environment in Asia, China is actually one of the highest yielding real yield environment. And because of this deleveraging process campaign causing yields to go up higher and positioning led to be yields higher, the economy itself actually doesn't need a very high or current high level of yields. So if you compare to, say, other economies where we're starting to see normalization and where real yields are very flat or even negative, China, from a valuation perspective, is actually very attractive. And at the same time, we have the potential of index inclusion as soon as the next year, which will lead foreign investors to be more passive and wanting to invest into China as well.
Well, this is it. If it all keeps going the way it has been, I suppose this is all going to be predicated on an economy which continues to actually deliver the goods in many ways. In fact, you could argue it's actually accelerating a bit. It
will accelerate, but at the same time, when I just mentioned about when the economy itself is going through a restructuring and is slowing at the same time, moving away from reliance on exports and more consumption-led, it's going to be a very big transition. And having yields being so high and impacting the way how corporates are borrowing or the cost of borrowing for corporates, China simply doesn't need such a high yield in the long run.